Financial statements. Financial statements are reports that summarize an organization's financial status and aid in managerial decision-making. The three primary financial statements are the income statement, balance sheet, and statement of cash flows. Financial statements are created for a period of time, often a month, a quarter, or a year. An income statement is a financial statement that calculates the firm's profit or loss by subtracting expenses from revenues. The basic format of the income statement is revenues minus expenses equals net income. Many income statements contain more detail and break down expenses into several categories. The first category of expenses is cost of revenues or cost of goods sold. For companies that are merchandisers or manufacturers, this includes all costs associated with buying or making the inventory that they sold during the period. On the income statement, revenues less cost of revenues equals gross profit. The next type of expenses is operating expenses. Operating expenses include all the expenses that the company incurs to run their business other than the cost of revenues. Operating expenses include research and development, selling expenses, and administrative expenses such as salaries. When we subtract operating expenses from gross profit, we arrive at operating income. Finally, there are some expenses that are neither cost of revenues or operating expenses. The most notable of these is income taxes. When we subtract taxes from operating income, we arrive at the firm's net profit or net loss. Looking at Google's income statement from 2012, we should first note that all numbers are in millions. As a result, Google had revenues of more than $50 billion during the year. This amount was reduced by cost of revenues of approximately $20 billion to arrive at gross profit of $29 billion. Their operating expenses of $16 billion and income taxes of $2 billion result in net income of $10,737 million for the year 2012. The balance sheet is the financial statement that supplies detailed information about the accounting equation as of the end of the period. You will remember that the accounting equation is assets equals liabilities plus owner's equity. The balance sheet includes details about the company's assets, liabilities, and owner's equity. On the balance sheet, the total of all the company's assets will be exactly equal to the sum of the company's liabilities and owner's equity. Looking at Google's balance sheet as of December 31, 2012, we see that there are three general categories of assets: current, fixed, and intangible. Current assets include cash and other assets that can be converted to cash within a year, while fixed assets includes items such as land, buildings, and equipment. Google also has intangible assets, such as patents or trademarks. We see that Google reports a large amount of goodwill, which is the accounting term for the amount paid for an existing business beyond the value of its other assets. Google also categorizes its liabilities as current or long-term, with current liabilities being due within the year. You can see that Google's total assets of $93,798 million are exactly equal to the sum of Google liabilities of $22,083 million and Google's shareholders' equity of $71,715 million, reflecting the accounting equation which underlies everything in accounting. The last major financial statement is the statement of cash flows. The statement of cash flows explains why the organization's cash has increased or decreased from the beginning of the year until the end. The statement of cash flows explains the increases or decreases in cash from three categories: operations, investing, and financing. The positive or negative cash flows from each of these three categories is added together to arrive at the net increase or decrease in cash. When you add this to the cash from the beginning of the year, you arrive at the cash at the end of the year. This statement is very important because cash is essential to the operation of the firm. If we look at Google's statement of cash flows from 2012, we see that they have a positive cash flow from operations of over $16 billion, but a decrease in cash from investing activities. This is not uncommon. The company made purchases of property and equipment necessary for a growing business. Finally, Google had a net increase in cash from financing activities such as borrowing and repayment of debt. The net increase in cash of $4,792 million is added to the cash from the beginning of the year to end up with the end-of-year cash balance of $14,775 million. Taken together, the three major financial statements, the income statement, balance sheet, and statement of cash flows, summarize an organization's financial status and aid in managerial decision-making.